What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. There's an economic crash coming. Whether you like it or not, there are economic cycles. There are times when the economy is hot, and then there's times when the economy is not so hot. Remember, there was a 2008 housing collapse, the 2001 dot-com bubble bursting, the 1989 savings and loan crisis, and the 1973 oil and stock market crash. These booms and busts are part of the economic cycle, so if you thought the market and the economy was never gonna come down, sorry to burst your bubble. See what I did there? But I think our next crash is gonna be something different. It's gonna be something like we've never seen before, and it's gonna be big. Most economic crashes usually have one or two factors coming together that trigger the crash. This time, I see 5 pretty significant factors coming together. Here's what they are, and here's what I think you should do. First is the digital revolution and the Amazon effect. Retailers have already started to feel this pinch. Dozens and dozens of major retail stores like Macy's, JCPenney, Sears, American Apparel, Michael Kors, and Payless Shoes have all announced that they'll be closing at least 100 brick and mortar stores so they can try and compete online. And don't forget that Amazon bought out Whole Foods recently, so you can expect grocery stores to feel it next. But these store closings aren't isolated. You're probably gonna see a chain reaction effect. The first people that'll be impacted by this will be the employees that work at these stores because they'll be out of a job. And even if a store stays in business, there's no guarantee that they'll need employees because we've already seen self-checkout lanes, and Amazon is trying to create stores where you don't even have to check out at all. It's all connected to your phone. Automation is affecting every single industry. So store employees are gonna feel it first, but don't forget about the brands that sell to stores like Macy's, because if people aren't going to stores like Macy's to shop, well, then they're not gonna see the brands that they sell unless they know how to get online. And many of them don't know how or aren't doing it. But this chain keeps going. See, these big stores like Macy's, JCPenney, and Sears are anchor stores at malls. Mall owners usually give these big stores free rent as incentive to be there because most people go to the mall for these big stores. And after someone's done shopping at Macy's or one of these big anchor stores, then they go shopping at the other stores in the mall. So these big anchor stores keep the small stores alive, and the small stores keep the mall in business because the small stores are the ones paying rent. Well, if these big anchor stores are starting to shut down, that means less and less people will be coming into malls, and so these small stores will be next in line to shut their doors. Once these small stores start to shut down, now the mall owners and developers are gonna start feeling the pain because the small stores won't have money to pay them rent. And these mall owners and developers don't just own a mall, they leverage their mall with lots of loans and debt. So if these mall owners and developers don't have enough money coming in, that means they won't have enough money to pay the loans, and so the big banks are gonna feel it next. If you think this is too crazy to be true, well, think again. Some places are already feeling it. The Galleria Mall in Pennsylvania was once valued at $190 million. But once the anchor stores started to leave, people stopped coming into the mall, so these small stores had to shut down, and then the developers didn't have enough money to pay their loans, so the bank had to foreclose on this mall. Wanna guess how much this mall sold for after it was foreclosed on? Take a guess. It was once valued at $190 million. The mall sold for $100. Not $100 million, but $100. We've just started to feel the effect of this, and this is just the first factor. The second factor is the auto crisis. For the first time in a while, the demand to own cars is going down. Lots of young people don't want to own a car anymore because of apps like Uber, and autonomous cars aren't that far away. Autonomous cars means less taxi drivers, less Uber drivers, and less truck drivers, and less cars on the road means less car manufacturing jobs. Plus, car dealerships aren't making the profits that they want to because of the increase of the supply of cars and the decrease of the demand for them. For a long time, it was cheaper and easier for people to lease cars, so a lot of people started to lease cars while the demand was hot for them not too long ago. After somebody's lease expires, the dealership takes the car back, and then they try to sell it as a used car. Well, a lot of these leases are starting to come to an end, so dealership parking lots are getting full with used cars, and because the demand to buy a car is going down, dealerships are having to cut the prices on their cars because people are not buying them. So the car market is kind of on choppy waters right now. The third factor has to do with the housing market. Millennials aren't owning homes like they used to. Some don't want to, and some just can't afford to. So the government and the banks are doing what they can to incentivize people to buy a home, with a loan of course, even if they can't afford it, because That's how they make money. After the 2008 housing collapse, the government created something called Dodd-Frank as a way to regulate banks and to require them to meet certain rules before they issue a loan. Well, Dodd-Frank was eliminated earlier this year, making it easier for banks to loan you more money. One of the main reasons people can't qualify for a loan is because they have too much debt. Well, if you have too much debt and can't qualify for a loan, there's gotta be something we can do. Oh, I got it. Make it easier for you to get more debt. A few months ago, the government passed a law helping people with too much student debt qualify for larger mortgages. Essentially, it says that if you can't qualify for a loan because you have too much student debt, it's okay for a bank to ignore that student debt altogether and pretend like it's not there. Here's a little secret. The banks and loan officers that give you a loan, they don't really care if you can afford the loan or not. They get paid once you sign the paperwork, so they just want you to take out a loan. After you do that, then they sell your loan to a different bank and let them worry about it. So it's becoming easier and easier for people to qualify for a loan even if they can't afford it, kind of like the early 2000s, and nothing is being done to teach people about debt management, and you'll see why this is so important with the fourth factor, the student loan crisis. Americans have over $1.3 trillion of student debt alone, and this number is going up every single day. The majority of people go into debt to go to school, to get a job, to make money, just so they can pay off their debt. It's a weird cycle, but it's becoming a real problem now because the cost of education is going up and the cost of things are going up, and the amount of money we're making is staying the same. Over the last 20 years or so, the cost of things have gone up by around 115%. The cost of education has gone up by around 500%, and the amount of money people make from their jobs has been pretty stationary. In 1971, the average college tuition was just 7% of the median household income. Now, the average college tuition is 25% of the median household income. People are spending all this money and time to get a traditional job, but these traditional jobs are the ones that are being wiped out by the first factor that I talked about. So let me put this together. People are paying more so they can make the same amount of money at a job where there is no job security, and now it's becoming easier and easier to qualify for more debt even though you barely have enough money to get by as it is. Half of the American population lives paycheck to paycheck, and 7 out of 10 people, the majority of people, have less than $1,000 to their name. We are walking a thin wire, and if anything happens to the economy or to people's jobs, a lot of people are gonna be underwater very quickly. And to top it off, number 5, older people don't have enough money to retire. Baby boomers are trying to retire, but they can't. Go banking rates found that nearly 1 out of 3 baby boomers over the age of 55 have $0 saved up for retirement. Nearly 56% of baby boomers over the age of 55 have less than $50,000 saved up for retirement. Baby boomers will need at least a few times that to think about retirement, and right now the majority of people are pretty far away. So what happens next? Well, baby boomers are already working longer, but eventually they won't be able to work and they're gonna need help because government programs like Social Security are drying up. And it doesn't look like their kids will be able to do it because of all the other factors that I talked about, so it might fall back onto the government to somehow find a way. That's a huge government cost because there's so many baby boomers, and now couple that with all the other financial crises happening at the same time. And right now, our economy is being artificially boosted because of government deregulation and because of government spending in certain industries like construction, but the government can't provide long-term sustainable jobs in these industries. Entrepreneurs have to do that. So there's a real serious problem brewing. It might not happen next week or next month. It could take years for us to really see the effects of these things. But once something's triggered, it'll be like a domino effect. One after another, these factors will trigger one another. So what should you do? For one, know what you're doing with your money based on where you are in the economic cycle. And number 2, stop relying on other people to make money. The dynamics of making money in this world are changing fast, and school and society are not keeping up. You can no longer rely on other people to give you that same financial security you saw 40 years ago. The world is moving digital, and even if you don't want to leave your job, you at least have to know how to create a second or third stream of income. If you want to see how you can start creating your own income or how you can start your own business, I wrote an ebook on how you can start making money on the internet. It's completely free, and you can read it on my website by clicking the link up here or by clicking the link in the caption below. What's up everybody? If you enjoyed the video, hit that thumbs up button. And what are your thoughts on this economic crash coming? Let me know in the comments below, and please share this video with at least one friend so it can help spread the word. Every single week we release new videos on entrepreneurship, business, and money, so hit that subscribe button and that notification bell below so you don't miss them, or hit this button right here even if you're on your phone. Follow me on Snapchat and follow us on Instagram over here, and check out some of our latest videos by clicking these buttons below. And as always, keep hustling.